first time in history, it's quite conceivable that the United States might have its credit rating downgraded. If the President and congressional leaders can't solve the debt ceiling crisis by August 2nd, U.S. Treasuries, the traditional gold standard of global finance, might go from AAA to AA+. A similar downgrade has happened to Japan and some European countries over the past few decades, but the impact on treasuries would reverberate much more severely since historically, U.S. government debt has been considered more of a safe haven during unstable times. So what happens when your safe haven isn't safe anymore? The threat of default, even the very idea of the threat of default, affects the treasury markets, which translates into people seeking other safe harbors. Now, with that in mind, I wanted to see how the Treasury market, in the form of the Dow Jones CBOT Treasury Index, is reacting to the crisis, and the different stories coming out every day by comparing it to two other indexes. The Dow Jones UBS Gold Index, since gold is a very popular play right now for people concerned about world events. And of course, the Dow Jones Industrial Average, which is the world's bellwether for U.S. stock markets, as well as our broader economy. Now, the reason for this exercise isn't purely academic. No matter what the outcome of this crisis, the near and long-term past have a story to tell. So let's take a look at the charts on the screen. We're going to work backwards chronologically. Now, this is a 5-year chart for the three indexes. What stands out, obviously, is the gold index's seemingly inexorable rise. The Dow Jones CBOT Treasury Index is up over this time as well, and up until recently, it matched its previous highs, which were in 2010. Now, the Dow, which of course took an enormous hit in 2008 and 2009 during the financial crisis, has climbed back up. Now let's take a look at the 2-year chart. Starting in mid-2009, the Dow and the Dow Jones UBS Gold Index have been, for the most part, on an upward trajectory, despite a few dips. The Dow Jones CBOT Treasury Index is up over the same period, but as can be expected from an index that covers a traditionally less volatile market like the U.S. Treasuries, it has nowhere near the return as the other two. Again, keep in mind that treasuries are generally considered a conservative investment option, but they may tick up in troubled times, though a lot of their rise over this period may also have been due to the Federal Reserve knocking down interest rates and buying up T-bonds to keep up the market. So finally, this last 6 months. This is the story, so to speak. As the debt ceiling crisis has become more severe, look at how the indexes have crisscrossed one another. The gold index broke out of the pack in February and kept going. That partially reflects investor concerns about the debt ceiling and a possible downgrade, because gold is always a favored place to put money in troubled times. On the other side, the Dow has been up and down, first gaining on some pretty strong corporate earnings reports, and then getting hit by investor fears about what's going on in Washington. And now, look at the Treasury Index. See how it seems to have benefited from the Fed's QE2 buybacks and low rates this year? If this crisis was about anything other than a potential downgrade, that number would likely be spiking up, since treasuries are often where nervous people put their money. But in the past couple of weeks, it's gone down, since there appears to be a genuine fear that it will be downgraded. Now, the debt crisis might be solved at any minute, and this little talk might be for naught. In fact, I'm hoping it does get resolved for all of our sake. But no matter what happens in the coming days, the numbers you saw tell an interesting story as the financial markets react to a political showdown unlike anything we've seen for a very long time. I'm Jamie Farmer for Dow Jones Indexes.